$40,000. That's the new SALT deduction cap starting in 2020-25, 4 times higher than the old limit. But here's what the headlines aren't telling you. Welcome to Money Moves Daily. I'm breaking down who actually wins from this tax change, who gets left behind, and exactly how to claim your share if you qualify. This isn't financial advice, but it is the clarity you need to have an informed conversation with your tax professional. The SALT deduction just got its biggest overhaul in 7 years, and if you live in New York, California, New Jersey, or Connecticut, pay attention. Because this change could put thousands back in your pocket, or it might not help you at all. The difference comes down to 3 specific numbers: your income, your total SALT liability, and whether you itemize. Get any of these wrong, and you leave money on the table. By the end of this episode, you'll know exactly where you stand and what moves to consider before you file. Let's start with the basics. SALT stands for state and local taxes. It includes your state income taxes, property taxes, and local taxes combined. Before 2018, you could deduct the full amount of these taxes from your federal taxable income if you itemized. No cap whatsoever. Then the Tax Cuts and Jobs Act hit. Suddenly, your SALT deduction was capped at $10,000, regardless of how much you actually paid. That hurt residents of high-tax states the most. A homeowner paying $15,000 in property taxes alone was already over the cap. Add in state income tax, and many households in places like New Jersey and California were leaving tens of thousands of potential deductions on the table. For 7 years, taxpayers in these states pushed for change. Congressional delegations fought over it. The cap became a political flashpoint. Now, finally, the cap has moved. Starting with the 2025 tax year, the SALT deduction cap jumps from $10,000 to $40,000. That's a quadrupling of the limit. But, and this is crucial, not everyone gets access to that higher cap. Income limits apply. This isn't a blanket increase for all taxpayers. It's a targeted benefit with specific thresholds. Let's break down who qualifies. According to Fidelity, the expanded SALT cap only applies to households with modified adjusted gross income of $500,000 or less. For married couples filing separately, that threshold drops to $250,000. The income limit determines whether you access the higher cap at all. The Bipartisan Policy Center reports that starting in 2026, the cap actually rises to $40,400, and it grows by 1% annually through 2029. So in 2027, expect a cap around $40,804. In 2028, roughly $41,000. Small annual bumps, but they add up over the 4-year window. But here's the catch. Fidelity explains that the deduction is reduced by 30 cents for every dollar of income over the $500,000 threshold. That's a steep phase-out. If you earn $550,000, your SALT cap drops by $15,000. Suddenly you're back to a $25,000 cap instead of $40,000. According to the Bipartisan Policy Center, households with MAGI above $600,000 in 2025 are effectively limited to the original $10,000 SALT cap. In 2026, that full phase-out threshold rises slightly to $5,000. The Bipartisan Policy Center notes the phase-out threshold also increases 1% annually. For 2027, expect phase-out to begin at $510,050 MAGI. These threshold increases track inflation, keeping pace with rising incomes. Fidelity points out there's also a floor. The SALT deduction can never drop below $10,000, regardless of how high your income goes. So even ultra-high earners, those making $600,000 or more, still keep access to the original $10,000 SALT cap. They just don't get the expansion. This creates a sweet spot. The Bipartisan Policy Center identifies households earning between $200,000 and $500,000 as the primary beneficiaries. Kiplinger confirms the states benefiting most are the usual suspects: New York, California, New Jersey, Connecticut, and other high-tax states. These states combine high property values with significant state income taxes. A $800,000 home in New Jersey can easily generate $18,000 in property taxes alone. Add California's 13.3% top marginal state income tax rate, and dual-income households can hit $40,000 in combined SALT liability without trying. But here's the reality check. The Bipartisan Policy Center states bluntly, low-income and middle-income households likely won't benefit from this increase. Why? Most don't have $40,000 in SALT liability to begin with. You need significant property taxes and state income taxes to even approach that number. And even if you have the SALT liability, you still need to itemize. TurboTax reminds us, the SALT deduction only applies to itemized deductions. ARP reports the standard deduction for married couples filing jointly rises to $31,300 in 2026. You only itemize if your deductions exceed that. For many households, even with the higher SALT cap, the standard deduction still wins. You need mortgage interest, charitable giving, and SALT combined. If your total itemized deductions don't beat $31,300, the expanded SALT cap provides zero benefit. You'd take the standard deduction anyway. This is why the change is targeted. Upper middle-class homeowners in high-tax states with mortgages and charitable giving. They're the bullseye. A household earning $350,000 in Westchester County, New York, paying $25,000 in property taxes and $20,000 in state income tax, that's $45,000 SALT liability. Under the old rules, they'd cap at $10,000. Now they can deduct the full $40,000, saving potentially $6,600 or more in federal taxes at the 22% bracket. At the 32% or 35% marginal rate, those savings climb even higher. We're talking $9,600 to $10,500 in potential federal tax reduction. But remember, and the Bipartisan Policy Center emphasizes this, the expansion is temporary. The SALT cap is scheduled to snap back to $10,000 in 2030. That's a 5-year window. 2025 through 2029. After that, unless Congress acts again, you're back to the $10,000 limit. This sunset provision matters for long-term planning. If you're deciding where to buy property, the 2030 reversion could change your math significantly. Some tax strategists are already gaming this. They're advising clients to accelerate state tax payments in years when the higher cap applies. TurboTax suggests considering the timing of property tax prepayments to maximize your deduction in years you'll benefit most. For households with variable income, commissioned salespeople, small business owners, freelancers, income timing becomes a key lever. If you can control when you recognize income, bonuses, business distributions, capital gains, you might push income to stay under the $500,000 threshold. Conversely, if you're well over $600,000, bunching deductions into alternate years might help. Some years itemize heavy. Some years take the standard. Now let's talk politics, because this change didn't happen in a vacuum. SALT has been a battleground between red and blue states for years. Critics argue expanding SALT primarily benefits wealthy households in Democratic-leaning coastal states. They call it a subsidy for high state taxes. Supporters counter that the $10,000 cap unfairly penalized residents of states that invest heavily in education, infrastructure, and public services. The truth: both sides have a point. This is genuinely redistributive policy dressed up as tax simplification. Your view depends on where you sit. So what should you actually do? First, calculate your total SALT liability. Add your state income tax, property taxes, and any local taxes together. If that total is under $10,000, the cap increase doesn't help you directly. You were already able to deduct your full SALT liability. If your SALT liability falls between $10,000 and $40,000, now check your income. Are you under $500,000 MAGI? You may have a significant new deduction. Next, compare your total itemized deductions to the standard deduction. Remember, married filing jointly, that's $31,300 for 2026. Only if your itemized total exceeds the standard deduction does the SALT expansion benefit you. Run the numbers both ways before deciding. Here's a concrete action. Pull last year's tax return. Look at Schedule A if you itemized. What was your total SALT deduction before the $10,000 cap applied? That uncapped number tells you your true SALT liability. If it was $25,000, you've been leaving $15,000 of deductions on the table annually. Now multiply that extra deduction by your marginal tax rate. That's your approximate annual tax savings under the new rules, if you qualify. If your income fluctuates near the $500,000 threshold, consider income timing strategies with your tax advisor. Small shifts can have outsized impacts. For those with discretion over property tax timing, ask your advisor about prepayment strategies. Some jurisdictions allow you to pay next year's taxes early. And if you're considering a move to a high-tax state, or out of one, factor in the 2030 sunset. The expanded cap is temporary. What happens if Congress doesn't extend it? You're back to the $10,000 cap, and your tax math changes dramatically. Plan for both scenarios. Most importantly, don't make major financial decisions based solely on this one tax provision. SALT is one factor among many. Your overall tax picture includes retirement contributions, investment gains, healthcare costs, and dozens of other variables. Zoom out before you act. And if you're in that sweet spot, $200,000 to $500,000 income, high SALT liability, already itemizing, consult a tax professional. The savings could be substantial. Let's recap. The SALT cap jumped from $10,000 to $40,000, but income limits mean this primarily benefits households earning $200,000 to $500,000 in high-tax states. The deduction phases out at 30 cents per dollar over $500,000. By $600,000, you're back to the old $10,000 cap. Most Americans won't benefit, either because they don't have enough SALT liability, their income is too high, or they don't itemize anyway. But for those in the sweet spot, the savings could be meaningful. Run your numbers. Talk to a qualified tax professional. Make informed decisions. That's all for today's Money Moves Daily. Remember, this was educational information, not financial advice. Consult a qualified advisor before making tax decisions. If this helped you understand the SALT changes, share it with someone who might benefit. Subscribe so you don't miss what's coming next.